Well, hello and welcome to my Dream for All update webinar for August 28th of 2023. Thank you all for joining me. I'm going to be providing some basic context on what's going on with Dream for All, what it is, how it works, and as much information as I can give you about how to be best prepared to utilize this program to help you make your California dream come true. So first of all, I want to start somewhat informally, and I want to kind of give you just some thoughts about what I think is happening, what I know is happening, and where I think things are going. This is really, for people who already know about the program, this is what you want to listen to, because this is me giving you where I think things are going to end up. If you don't know what the program is, stick around anyway, because once I get done with my ramblings, I'll explain what the program is and how it works, and what you can expect versus what we don't know to expect. So let me freeform for a little bit. First and foremost, there's a budget process that enacted the Dream for All money that actually has some really important deadlines coming up. So June 30th, July 1st, was the start of the budget year. And we know we have a certain amount of money set aside for this year. Now, the money doesn't have to be spent this year. That's a misunderstanding that even I thought that the money had to be spent before June 30th. And it doesn't. It was allocated, but they can actually hold off and release the money whenever they want to. So here's the second piece, though, of how the budget process works. And that is that the state assembly does something called a trailer bill, as in trailer to follow or coming behind. So you got the original budget that said, hey, we're going to set aside $200 million for Dream for All for the 23-24 budget year. But how exactly are they going to require that money to be spent? The state assembly will be making that decision. Now, there's a state law that says the assembly trailer bills for this year's budget have to be written and in place by September 14th. So we're 2.5, 3 weeks away from the trailer bill being given to CalHFA. Once CalHFA gets that, they're going to be told lots of important things about the program. So I'll give you some examples of some things that we think might happen. But for example, they might say, hey, this program is only available for people whose parents have never owned a home before. So that's called first generation homeowners. So it's the state legislature that is right now putting the final details on how to spend the money. And so when the state legislature takes that process and they allocate the guidelines. Now, this is different than, hey, what's the credit score got to be? How much is my income limited to be? So it's really this part of the process is the state saying, hey, we want to set big picture rules. I'm going to go through a little bit later in my PowerPoint presentation and explain to you some of the rules that I think they're going to be implementing. As an example, like I said, generational a couple minutes ago, I think there's a chance that they might want to allocate money based on certain regions within the state. So there's a program right now called the Housing Affordability Fund that was created by the California Association of Realtors. And it was offering $10,000 grants for first-time home buyers who met certain income thresholds, nothing to do with Dream for All, but I'm using this as an example. They budgeted the money and they said, you know what? We're going to take half of the 500 million we have and allocate it to the northern half of the state. And we're going to take half of the money that we have and allocate it to the southern half of the state. And what that meant is Southern California, as a matter of fact, in this case, ran out of money far faster than Northern California. And they can allocate different loan programs with this type of characteristics, can allocate geographic restrictions. Now, why do I think this might happen? Because I've been doing reading on what the state legislators have been asking about Dream for All money, and they were asking for reports on where the money was spent, what counties got the majority of the money, and it appears that Sacramento County got the majority of the money. And I got a feeling that there's other parts of the state that feel like they didn't get their fair share. So I wonder if there might be a provision in there that says, hey, certain parts of the state, maybe even counties, might be able to get, hey, this county has a certain population, and therefore we want to make sure that this county doesn't get more than their fair share of the money. So there's a lot of things that the state can put in place that says this is how we want the money to be allocated. Now, beyond that, the September 14th deadline is critical. Doesn't mean we're going to hear anything on September 14th, but it's why CalHFA at the end of June said, we're going to tell you a timeline this fall, because they knew the deadline, that they had to hear back from the state of California by September 14th with the final rules that the state was passing off to CalHFA. At that moment, the state of California gives up control of the money, and it now belongs to CalHFA. That's when CalHFA knows what the rules are, and now they've got to figure out how to implement those rules. How do we track if somebody's a first-generation homeowner? How do we know that their parents, and I'm not saying this is a rule, I'm saying this is a potential rule. How do we, if they say they want first-generation homeowners only, how do we track that? If they say only a certain number of dollars per county, how do we allocate it? How do we notify people when their counties run out of money? How do we budget the money? Because every loan isn't the same purchase price. And so are they going to allocate it based on, hey, every county only gets a certain number of loans or a certain dollar amount? Because if it's a dollar amount, the high cost counties don't get as many actual loans. If it's based on loan numbers, then the high cost county will get a bigger share of the dollars, because you're buying $1 million home in San Francisco versus a $300,000 home in Fresno. That means that it takes 3 Fresno buyers to equal 1 San Francisco buyer. So are you allocating it based on people or dollars? Those are all the questions that CalHFA needs to figure out. So my gut says they're not going to get that figured out anytime soon. My gut says we'd be lucky to see this money in 2023. I think we're likely to see it early 2024, and we're going to know better in the next 30 days. So the last Monday of every month, I'm going to host this webinar and provide this information every month until we know the release date, and then I'll probably do it weekly leading right up to the release. But what I want to do is provide you some context, provide you some big picture of where I think this is going to land. I think that there was a major debacle that was created in March of this year when the first round of Dream for All money was released. Now, what was the debacle? The debacle was you had people racing to get an offer accepted on a home because they had a deadline that says, hey, you can't get this money if it runs out before you find a home. And it caused people to make decisions they wouldn't otherwise have made. So it puts somebody in a position to say, you know what, I have to trade my good, well thought out decision-making process with a rush to get it done in the deadline. It's like those TV shows we used to see where you'd have a shopping spree and you'd have 3 minutes to fill your shopping cart with as much stuff as you can in the toy store or in the grocery store. And in the heat of the battle, in the rush and the adrenaline of trying to get it done, you make decisions you wouldn't have otherwise made. You don't have the time to think about it and make a good decision. And I'd be surprised if CalHFA allowed that to happen again. I think they've got to do something different with how they reserve the money, because the way they did it really matches how they do all the rest of their programs, which is, hey, we got an unlimited amount of money, or at least a reasonably unlimited amount of money. And so when you get an offer accepted on a home, we lock your interest rate, we set aside your money, you're good to go. Because there's no expectation the money is going to run out. So there was no worry about having to have a process that allocates the money first. And I think they're going to have to change that. I think they're going to have to put some form of a process in place. Now, I don't know what that looks like. I mean, I've been thinking a lot about it. It could be any number of things. It could be a first come, first served reservation system that says, hey, as long as I put my name in the queue, I get a ticket, and my ticket says I can have the money. Now, how do you know that that person is actually qualified? Is it right to let people put their name in the hopper if they're not qualified? But then again, how do you know the lender didn't just say they were qualified? It's really tough. I started thinking a lot about, well, what's the closest related situation that I've ever seen? And it was builders building new homes that had a huge amount of demand for those homes. And this was, you know, especially going back 20 years ago, but even in the last 10 years, you've seen builders building homes where you've got people camping out overnight to be the first in line. It's like Best Buy selling a 60-inch TV for $59 on the Friday after Thanksgiving. And you had people camping out for 3 days. It's like Chick-fil-A. Chick-fil-A? Yeah, Chick-fil-A. I think every time they open a Chick-fil-A, they say, hey, the first person in line to order at the brand new Chick-fil-A gets free Chick-fil-A for a year, free Chick-fil-A for a lifetime, or something. Hey, any Chick-fil-A is good. Free Chick-fil-A is great Chick-fil-A. But the problem is people start saying, well, man, I think somebody's going to show up, at this time, then I got to show up at that time, and I got to show up even earlier than them. And it creates a fight. It creates a battle when somebody steps out of line to go to the bathroom and you're not in line anymore. Now, I'm not being literal. That's not how it's going to work in this situation. But Cal HFA's got to think about it and do something that is going to change the way that people are getting the money. And so there's going to be a need for them to come up with some form of process. Now, my guess is, as I think about it, they're going to have to do something. First come, first serve, a lottery system that says, hey, everybody who wants a chance to get the money, put your name in this hat and we'll randomly draw them. And if your name's pulled, then you've got money set aside. But then they got to wonder, how are they allocating it? Because maybe you're buying $1 million home and that's worth 3 tickets compared to somebody buying a $300,000 home. You could have 3 people buy at ththose prices. So there's a lot CalHFA has to think about in their implementation of this. And maybe they could do it the same way they did before. But I think that would be irresponsible. I think that if they simply said, hey, all right, everybody get to the starting line and whoever finds a home first, you get the money, you're going to create unintended consequences. You're going to have people writing offers on homes they wouldn't have otherwise purchased. You're going to have people writing offers for prices higher than what they otherwise would have spent because they figure, hey, I've got 20% free money. This is not free money, okay? But in their minds, I've got 20% free money that I don't have, that's not mine. So I'm playing with house money so I can wager a lot more. I can offer a lot more. And it's still your money. You're paying back the Dream for All funds, and I'll explain more about it when I hop into the PowerPoint, but you're paying back the money. So don't fool yourself into thinking it's not your money. And hey, I'm buying a $500,000 house and I'm only spending $400 of my money, so I could bump it to $600,000, and I'm only paying $500,000 of my money for a $500,000 home. Well, that was silly. You spent $600,000 for it and you got to pay back the other $100,000. So don't get in that position. But that's why I think that Cal HFA is going to have to change that. So why do I outline all of these? Because I want to be really clear. By the next meeting that I do, the last Monday in September, we're going to have a lot more information, I think. I expect we're going to hear from CalHFA, and they're going to give us an idea of timelines, but just recognize there's a lot of work they've got to do to make sure that whatever comes from the state by September 14th is able to be implemented into the loan program. So a lot that I covered without really telling you a whole lot. So let's dive back into my PowerPoint and let me go through kind of what is the program, how it worked before, how I expect it to work, and kind of where to go from here. So here we go. Hold on one second. I got to pull up my chat. Okay, if you have questions, by the way, if you're watching live, feel free to post a question into Zoom chat. If you're watching recorded, post a question into YouTube chat or comments, and I'll get back to it later. All right, so let's do the Dream for All. Let me make sure I'm sharing the right thing. I am. Beautiful. All right, so here's what we're going to cover tonight. In the next 40 minutes, we're going to talk about what is Dream for All, when is it coming back, what do I need to do to prepare for the next release, should I wait for the next release or should I buy now, and then we'll have some Q&A. So here we go. First of all, Dream for All is a down payment assistance program. As a matter of fact, it is the best down payment assistance program I have ever seen in my 23-year career. Now, a lot of people have a lot of strong opinions about this. I think it's an amazing program, but it definitely comes at a cost. It is not free money. So I don't want anybody to think I'm getting free money. You pay back a percentage of your appreciation when you sell your home, or when you refinance, or when you finish and you pay off your mortgage at the end of 30 years. Okay, so I'll go into some specifics about how shared appreciation works. So basically what you're looking at here, let me get my handy dandy little pointing tool. And what we're looking at is shared appreciation says, hey, I'm buying a $500,000 home. And I get a $400,000 first mortgage loan. and a $100,000 Dream for All appreciation loan. 5 years later, that house has gone up in value. It's worth $640,000. Now, that's an estimate. Nobody knows where house prices are going to be, but historically, they've continued to go up. Even in the worst of times of 2007, when prices fell, they were back to where the peak was within 7 years. So there's never been a situation in history where home prices have dropped and not rebounded within a 10-year time frame. And really, most of the time, it's been closer to 5 to 7 years at the worst case. So you've got a home that you bought for $500,000 that you've appreciated $140,000 in the value of the home. Now, when you sell your home, you take that $140,000 increase between what you bought it for and what it's worth. You get to keep 80% of that. The Dream for All program gets back 20% of that. So when you sell your home, you're paying back the $100,000 that you borrowed plus the $28,000 of their share of the interest. Now, again, you sold the house for $640,000. You're paying them back $128,000. Your balance on your mortgage has gone down because you're making a payment every single month. So this $400,000 goes down, and after 5 years, you only owe $370,000. So when you sell the house for $640,000, you get $142,000, and you're saying, wait, John, this is funny math because the house only went up by $140,000. How am I getting $142,000? Because your first mortgage was paid down by $30,000, and you get $112,000 of this appreciation. The state gets the $100,000 they originally gave you, plus $28,000 of the appreciation. So then what happens is when you sell that home, that money is recycled back into the Dream for All program. The whole point of this program was for it to be funded every year, excuse me, for 10 years. And after 10 years, there's enough money in the system that every time somebody sells a house or refinances or pays it off, the money goes back into the program and it never runs out of money. That's the goal. The problem is we got to get there. We have to continue to feed the money into the system so that later on there's enough money to keep coming back out of it and continue to grow and pay for the people in the future to use this same amazing program. So there are 3 circumstances in which you have to pay back the money. You pay it back when you sell the home, and they use a sales price to say, well, you're selling it for $640,000 and you bought it for $500,000. The state gets 20%. You as a seller do cover all of the closing costs. The seller takes 20% of the total appreciation. They don't take into account any of the costs of selling the home. When you refinance, now the original rules were published back in March. The new rules have not been published. Anything I talk about regarding proposals of what the program is going to look like, for example, this one-time ability to refinance without triggering repayment, technically, they could change the rule. And they could say, nope, we're not going to allow that. You've got to pay it back as soon as you refinance. So take it with a grain of salt until we get the final set of rules. But the original rule book, which I think will be the same, is you can refinance once without having to pay back the appreciation. But if you do a cash out refinance or any subsequent refinances, you have to pay back the appreciation. And also in 30 years. So this is the piece people misunderstand is they say, well, John, I'll just keep the loan. I'll never refinance. I'll never pay it off. I'll never sell the house. So therefore, I never have to pay back the state. The state will get their money. In 30 years, when you're done paying your mortgage, the state is going to get their money. So just be aware, you will have to pay them back. And at that point, CalHFA is going to order an appraisal or an online valuation of the property, and you'll pay them back your original amount plus 20% of the appreciation that you'll either have to write them a check or you'll have to do a cash out refinance to borrow the money to pay them back. And again, at that point, most people would refinance to pay back the state. And the most you have to pay them back in interest is 2.5 times the original balance. But that's a lot of money. If you got $100,000 from them and you have to pay back 2.5 times that, you're paying back up to $250,000. Now remember, that means your house went up a whole bunch in value in order for you to have to pay them back $250,000 in appreciation. All right, so Is this a good idea? Should I, John, I'm listening to you. I'm thinking about this program. My buddy said it's an amazing program and that I should wait for it to come out because I need to do it. And so let's be real. Is it a good idea? Well, here's the pros. You're only making payments on 80% of the price. So your monthly payment is going to be lower. And interest rates are stupid high right now, like stupid high. They're at 7 to 7.5% depending upon the day. That's significantly higher than the 2.5 to 3.5% rates that we saw in 2020 and 2021. Now, are we ever going to get back to those rates? I don't know. But I do think we're going to see rates in the 5s and in the 4s. I just don't know when it's going to happen. You would have watched any of my videos a year ago or 6 months ago. I was saying, hey, I think by June of 2023, we'll see rates back down in the 5s. I missed that one. We're 2 months later. We don't have rates in the 5s. We're in the mid 7s. So just be aware, you're making payments on 80% of the price, which is a good thing because we've got significantly higher interest rates. This offsets the affordability problem that was created with inflation. And you don't have mortgage insurance. Now, there's an option where you can use some of the money to pay your closing costs and some of the money to pay your down payment. In that case, you don't have 20% for a down payment and you do have mortgage insurance. But if you use the money completely to pay for down payments, you don't have any mortgage insurance. That can let you buy a bigger home, buy a better home. Maybe the home prices you've been shopping at have been at $400,000 because that's the only payment you can afford. Well, this program would allow you to buy a $500,000 home at the same payment as what you've been looking at for a $400,000 home. Or you have a lower payment. You might say, look, I've been looking at houses at 400 grand and I like them, but I'd rather spend less per month. I don't want to have to stop going to the movies and I don't want to have to stop going to get my Starbucks. And so I'd rather have a lower monthly payment, and this program provides that for you. And most importantly, stop renting. Rent payments keep going up and up. We've all seen it. You get no tax deductibility. You get no appreciation of the home. None of your rent payment goes into future savings for you. All of those things are true when you're a homeowner. But here's the negatives. You get a lot less money from the sale of the home. Now, you invested less money, but you get less money back out when you sell the home. So if you have your own money to put for a down payment, you're better off investing in yourself than letting somebody else do it. Another negative, you pay all of the closing costs. So if you sell that house, you're paying all of the fees to sell the house, even though you're only getting 80% of the appreciation. So it's something to be aware of. And you can only refinance once without triggering repayment. Now, why does that matter? Because as rates go down, let's say you get a loan right now and it's at 7%. And in a year and a half, rates go to 5.5. Do you refinance or do you wait for 5? Okay, you decide to wait for 5. Okay, so now they're at 5. Do you refinance or do you wait for 4.5? I don't know. So they hit 4.5. Do you refinance or do you wait for 4? Because you only have one bullet in that chamber. You only have one time that you can refinance before you have to pay back to the state. And so you may postpone. It may go to 5.5 and you're like, oh, I'll wait for 5. And then it goes back to 6 and you lost the chance to save money. A normal loan, you could refinance and then you can refinance again. Now it costs you a little bit more in fees to refinance. So I'm not telling you should refinance often, but this is a bigger hit. This is going to make it's more painful when you have to pay back that money because you got a big chunk of money you got to pay back to the state, and you have to start making payments on that money once you trigger repayment. Okay, so a couple of success stories. I won't spend a lot of time. Last month when I did this, I spent a lot of time on my success stories. I'll briefly say, look, I helped 9 families on the original round. Now, there were 2,500 families who got the money, but I'm proud that I helped 9. It doesn't sound like a lot out of 2,500, but I haven't met anybody yet who did more. So I feel pretty good about that number. And really, it's about the message I've been sending out there and helping people understand it has helped people recognize that I'm the right person to work with to help guide them through the process. The thing about these Dream for All loans is they're all the same when it comes to the interest rates, and they're all set by the state of California. So the cost of an appraisal, the cost of mortgage insurance, it's all the same no matter what lender you're using. And so you're not shopping around to find a lender that's going to give you a better interest rate. So with this program in particular, and by the way, in real programs, other loan programs, there is a difference. You can shop around and find somebody who charges a little bit less. Got to be careful, you get what you pay for, but you can. In this case, you can't. The rate is set by the state of California. And so you want to work with somebody that you're not paying anything extra to, but they are an expert in what they do. And I want to be really clear, I'm interviewing to be that expert. Like, I want to guide you through this process. And so I want to talk to you about some of the things I was able to do to help people. So I helped a family in Pacifica buy a $1.2 million home. And we used the 20% to cover their down payment and all of their closing costs. They literally paid nothing out of pocket. They actually even got $97 back as a principal pay down on their loan. So they bought a $1.25 million home with no money out of pocket. Another family in Stockton bought a $397,000 home, and they only needed $102 total, like grand total. They only needed $102. Helped another family in Los Angeles buy a $1.05 million home. They got 20% from the state. They applied all of that towards down payment, and they used their own money to pay for closing costs. Helped another family in Lodi buy a $397,000 home. They decided they were already going to put 5% down. Excuse me, they were going to put 10% down, and they decided, hey, you know what? Instead of using the Dream for All money, they put, or instead of using 20% from Dream for All, they decided to only take 10% from Dream for All, combine that with 5% of his own money and his own money for closing costs. That meant he only had to pay back, and I think I got my numbers wrong, he got 15% from the state. So 5% from him, 15% from the state, but it means instead of paying back 20% of how much the house has grown, he's only paying back 15. So there's ways that we can structure this, and I'm really, really experienced, and I say experienced, this program's only been around this year, but I understand how lending works. I've been doing this for 23 years. Tenure doesn't make me good at what I do. I'm good at what I do because I understand lending really well, and I know how to navigate these waters. Okay, so let's talk about what the rules were the first time. And I say what the rules were the first time because I cannot promise you these won't change. I'll tell you which ones I think are likely to change and which ones I think are not. So you had to be a first-time home buyer. That meant you didn't own your primary home in the last 3 years. You could own a rental property, but you couldn't have owned your primary home or your spouse, and you could not have lived in a home owned by your spouse anytime in the last 3 years. No co-signers were allowed. So you could not get your mom and dad, your aunt and uncle, your sister to co-sign. If they're going to live with you, that was fine. But if they weren't going to live with you, it wasn't allowed. You had to have at least a 680 FICO score. And if you met the low income threshold, you could go as low as 660. It was a Fannie Mae conventional loan. Now, let me pause for a second. Fannie Mae is related to Freddie Mac. So Fannie and Freddie are the two semi-government companies that set the rules for conventional loans, but they have different rules. Fannie Mae has one set of rules and Freddie Mac has a little bit different rules. So this assistance program only uses Fannie Mae's rules. 99% of the time, it doesn't matter. But there's some little things like student loans. Fannie Mae and Freddie Mac treat student loans differently. If you're self-employed, Fannie Mae and Freddie Mac treat how we calculate income for somebody who's self-employed differently. So just be aware, this is a Fannie Mae only loan. It's owner-occupied properties only. So you cannot buy a rental property. You can't buy a house that you're not going to live in. You must live there, and everybody on the loan must occupy the property. And you could combine up to 30% of your own money with 20% of the money from the state. So you could buy $1 million home. You could get $200,000 from the state and put up to $300,000 of your own money for a down payment, and you're only making payments on a $500,000 loan on $1 million home. Now, I'm going to pause here for a second. Of everything I've said on this screen, everything I think will continue to be true, except this last one. I gotta wonder, because you had people, this money disappeared too quickly. And I think they're going to restrict it to people that don't have so much of their own money. I think they're going to have to put, I don't have to, but I feel like they're going to put some kind of a restriction that says, look, you can't put more than X amount of your own money into this, because if you have 30%, if you have $300,000 of your own money and you're buying $1 million home, I don't think you need another $200,000 from the state. You have enough money to buy a home. That $200,000 probably should have gone to somebody who didn't have $300,000. And look, if you couldn't make the payment work on the $1 million home, then buy something at $800,000. Now I know that's easier said than done because there's markets like the Bay Area where there's nothing at $800,000. There's some parts of Los Angeles County and the greater Los Angeles area that you can't buy anything for $800,000 and you have to spend at least $1 million. So I get it. I totally get it. But I just wonder if they're not going to change this last rule a little bit. The rules also, you have for a bankruptcy, you have to, if it's a Chapter 7, it has to have been 4 years old at the time we do the loan. If it's a Chapter 13, it has to be at least 2 years old at the time that we do the loan. All right. And it has to be at least 7 years after a foreclosure unless you had a bankruptcy first, and then we use the bankruptcy rule. So of everything on this chart, these last two I'm positive are going to stay the same. I'm positive it'll be owner occupied. I'm positive it'll stay Fannie Mae only because CalHFA only does Fannie Mae loans. I don't think the FICO score is going to change. It might, but I don't think so. I don't think the cosigners are going to change, and I don't think the first-time homebuyer requirement is going to change. But I feel like this one, honestly, my personal opinion, it should change. All right. So how much money was there? Originally, there was $500 million pledged, but the budget was cut short in January, and they dropped 40% of that money. So they allowed $300 million to be released, and it was released on March 27th. By Thursday, April 6th, they said, hey, that money's probably going to be gone by next Wednesday. It didn't last. Thursday night, they announced that at 3:30 in the afternoon. By Friday morning at 11 a.m., the money was gone, like gone. And as a matter of fact, I had 3 clients that I needed to register for loans that morning. I registered the first one at 8 a.m., and I got my confirmation at 8:45. I registered the second one at 8:15, and I got my confirmation at 10:45. 15 minutes after I registered the first one, and 2 hours later when it was actually processed, I registered my third one at 9:30 before the money was gone at 11, but it didn't make it. By the time it got processed through the system, the money was already gone. The backlog was already there. This is what I expect the state to do something about. I expect the state to put some form of a system that says, hey, you have a money, your money is set aside. You have a certain amount of time to go find a home. Now, I don't know how long, a month, 2 months, 6 months, I don't know. But I feel like that's the responsible thing for them to do. And so I would expect that they're going to do something to allocate, hey, you have money waiting for you, you don't. But at least you know, I'd rather know than to be shopping and getting my hopes up and then finding the money's gone the morning that I went to get my offer accepted. So that helped about 2,500 families. Now, the state pledged to provide $1 billion a year for the next 10 years, but will they do it? Well, here's the deal. They didn't this time. This time they offered for 2023, 2024, they have $200 million. That's $100 million less than last year's money. That means they're going to help 1,650 families instead of 2,500. So when's it coming back? It's going to come back after we get the trailer bill from the state legislature. The deadline for that is September 14th. At that point, once those rules are in place, then CalHFA has to get to work. They have to figure out how to implement it. I think that's going to take a few months. So I think they're going to tell us, like they said, they announced it, they'll give us a timeline in the fall. But they first have to get this trailer bill. Then they'll give us a timeline that says, hey, we think it's going to take this long for us to work through everything. And I think we're going to see the money maybe this year, but more likely early next year. All right, oops, hold on here. All right, so what changes do I think they're considering? First of all, I think that there's a chance they're going to make it, if they don't have some form of a lottery, I think they should consider contracts after the release date. Because a lot of the money was actually used up by people who were already in contract. They'd already planned on putting their 20% down. And they said, well, man, I'm in contract and it's, March 15th. And well, this money happened to come out while I was in the middle of my escrow period. And why not use it? So they went ahead and changed up and kept extra money in their pocket instead of using it. So those people, I think, need to be separated out and saying, hey, if you got in contract before, you didn't plan on using this money. We don't want it to go to you just because you happen to be in the right place at the right time. We'll see if they do that, but that's one of the things I think they should do. There's a feeling on my part that they might do something generational. Just some of the questions I've seen from legislatures talking about it, that I think that they're going to do something and say, hey, it's only for first generation homeowners. If your parents owned a home, then you cannot buy using this program. Now, this is going to be tough to track. What does it mean? I mean, if your parents owned a home 20 years ago and they passed away 15 years ago, does that mean you can never use this program to buy a house? I don't know. Personally, I think this is theoretically a great idea to help first generation homeowners. It's going to be impossible to track. It's going to be impossible to implement. And so I'm worried about this one. I'm not so sure, but I've heard some grumblings, or I have some feelings of the things I've read from the state legislature. I wonder, or I think they probably need to make it needs-based. This is my feeling, that they need to take away the ability to use up to 30% of your own funds. Oops. And I think that they should limit the amount of money any one person can access. My personal opinion, and I actually did share this with the people at the state, is I said, I think you should put a cap on the dollar amount. I think you should say, hey, maybe we should make the limit $100,000. So if you're buying a $400,000 home, you get your 20%, that's 80 grand. If you buy a $1 million home, 20% is 200,000. Maybe we only let each person get a maximum of 100,000. That's one way that the lower priced homes can still get the full 20%, but the high priced homes don't take all of the money simply because they bought a $1 million home and you get $200,000 of the money. And I think I know that there's been some grumblings about reducing the income limits, because there's been talk that the income limits were too high. Now, I also heard some grumblings that some of the highest cost counties feel like they didn't get their fair share. So those legislatures, those senators and assembly people, they're going to be more concerned about, hey, I want to keep the income limits high because I want people in my district and my constituents, I want them to be able to access the money. And in my area, we need to have higher income. So I think that's a battle that's going on right now in the state assembly that has to get figured out before September 14th. So speaking of income limits, here's the old rules. The new rules are not known. So the old rules were you could theoretically qualify up to the county limit of $160,000 or more. Some of the highest counties were up to $300,000. And you can scan this QR code to get just a rough idea of what the old rules looked like. And you'd get some extra bonus benefits if you were under this 80% limit. You didn't have to pay back as much of the appreciation. You had lower credit score requirements. There were some other benefits. So this gives you an idea of what the old income limits were. And in some counties, you could make as much as $300,000 and still qualify for this program. All right, so let's talk about how to prepare you for this program. First of all, the most common reason why people missed the first time was because they didn't have their credit score in line. I don't know what the new credit score rules are, but I have every expectation it's going to stay the same as the original rules, which means you got to have at least a 680 credit score. So let me do a soft credit pull. A soft credit does not cost you any money. It does not ding your credit report, but it lets me pull back the curtain and take a little sneak peek to see what's going on in there, to see what's happening with your credit. And I can run my simulator to give you an idea of what you can do to improve your credit. Because I had so many people frustrated because they came to me in early March saying, okay, I want to do the Dream for All program when it comes out. And I said, well, you got to pay off these 3 bills and you need to fix this collection. And it'll take you about a month to get it fixed. And by the time they got it fixed, the money was gone. Now is the time we need to be looking at your credit, and do not look at Credit Karma and say, oh, I'm at 680, I'm fine. Do not look at your credit card bill and say, oh, I'm over 680, I'm fine. Because it's a different score. The score you get from Credit Karma, the score you get from anywhere except the mortgage company, except one place. If you go to myfico.com and you sign up and you pay their monthly fee, they actually have the option to pick the mortgage credit score. So that is the mortgage credit score, but nothing else is. Don't pay a fee to myfico.com. Come to me. It's free for me to do a soft credit pull. All right. You need to save up some money because you have to have money to pay for certain things. What you're going to need to pay for is you're going to need to pay for your earnest money deposit. That's the upfront money that you need to put as a deposit to the seller. Now, I told you about how I got people in for a $1.2 million home and they paid $0. Matter of fact, I credited them $79 towards their first payment. But they had to come up with a lot of money to make sure the seller knew they were serious. They had to come up with $30,000. I think it was $30,000 or $40,000. That now it's a $1.2 million home. Don't get scared off. You know, on a smaller priced home, those dollars are a lot smaller. But you have to come up with an earnest money deposit. You have to pay for an appraisal. That's $600 or $700. You got to pay for inspections. You're going to get a home inspection, a roof inspection. None of those things are included in the Dream for All funds. You can't say, oh, John, I won't pay for the appraisal. We'll just include that at the end. No, you have to pay for the deposit on the appraisal. I can refund you the appraisal money once the loan closes, and we use Dream for All money to pay the appraisal, but the appraiser has to get paid right away, because if the house isn't worth what you're paying for it, you would want to know. You don't want the appraiser to only get paid if he tells you the house is worth it, because then they're going to tell you it's worth it all the time, because that's the only way they get paid. That's not a good idea. You want the system to work the right way, which is the appraiser gets paid immediately and you have to pay them. The same thing with your home inspector, your roof inspector, your pest inspector, any other inspections. You need to know your numbers. You need to know your budget. You need to know your price range. You need to know, by talking to me, what you're shopping for, what areas you're looking for, and you've got to pick a realtor. I know some absolutely amazing realtors that if you don't have a good realtor, I can get you connected with one. But you've got to have a realtor that starts giving you an idea of price ranges. It starts giving you an idea of what areas you want to search, so that when the money is available, you've got the ability to move forward immediately without having to start your search and start figuring out what you want to do. You want to have that narrowed down now and be ready to act fast. Now, this actually, I didn't update this, and I should have updated it, because I don't think we're only going to have one weekend to compete. This was from my presentation I did a month ago, but the more I think about this, the more I dig into it, I think it would be a really poor move of the state to do that again. And so I feel like they're going to do something that's going to be more of a reservation lottery-like system. I just can't imagine. Now, they might do this, and if it ends up that way, then you've got to be ready to act fast, because the money will run out quickly. But the more I think, the more I really consider what the options are. I think that the state has to do that. Yes, Linda, I can send you a copy of the recording. No problem at all. All right, so that's what you need to do to be prepared. You also need to start with your home buyer education. The home buyer education it's a first-time home buyer course. It costs $100. It takes 8 hours. It doesn't take 8 hours. It's a lot faster. It includes a 1-hour session with a counselor, one-on-one. This is what got very, very backed up last time. I don't think it'll be backed up this time, but I think it's important to get this done and out of the way sooner. And this is good for a year. So you can get it now, and that certificate is good for a year. You also do shared appreciation. It's online only, but you can do that later. No cost, no waiting period, no need to worry about that right now. So if you want details on that, you can scan this QR code, or you can go to californiadreamforall.info/education. All right, so my last question, should I just buy right now? Here's the deal. Buying now gives you a few benefits. You avoid buyer's remorse, because you're going to, whether you have a weekend or a couple of months, you have a really short period of time to make a purchase. Versus if you buy now, you get to think about what you're buying and make sure that what you're buying fits your needs. You get to take some time to look around and not have to settle on a home. I've got 6 different ways to buy a home with 0 down payment. So if you're thinking, man, this is the only way I can buy a house with 0 down, that's not true. Especially because you buy now and you don't use this program, you don't share any of your appreciation. I know we were taught in kindergarten to appreciate people. Yes, appreciation is great. Not sharing the appreciation that is your money. And the other thing we're taught in kindergarten is to share. I think sharing is great, but not sharing your money without that person needing to. So buying now means you don't have to worry about sharing the appreciation. By the way, there's a lot less competition, because we're going to see more competition. First of all, you're going to see more competition as everybody's out there trying to make sure they get one of these homes fast enough. And secondly, as interest rates normalize more, as people get used to rates being at 7.5, more people are saying, fine, I'll just buy anyway. I've waited a year for rates to drop and they haven't. Might as well just go ahead and bite the bullet and buy. So it's important to understand there's a lot less competition right now. So guys, that's about it for what I've got for you today. If you want to make your dream a reality, then scan this QR code and you can absolutely get started. This is the QR code that gets you to my site, so you can input your information. We can show you what all your options are. You can schedule a time to meet with me. And this QR code here takes you to a list of videos that go through all of the details of how the first version worked, in case you have specific questions about that I didn't cover tonight. So I really, really appreciate you all joining me. Again, go download my mobile app and let me help you make your dream a reality. So thank you everybody for joining me tonight. I hope you have an absolutely wonderful day and enjoy the rest of your night, and we'll talk to y'all soon. Bye-bye.